Hey everybody, welcome. This is just I want to do a brief overview of the first chapter and not really even the whole chapter. There's a lot of stuff in here that you can just read out of the book, but I wanted to hit the concepts that are pretty challenging for most people. And so I want to start with the basic accounting equation, which you can see up on the screen there is assets equal liabilities plus equity. And we'll talk a little bit more as we move forward as to what all these things mean, but just recognize that is the basic equation we're going to use for accounting. Assets are things that a business owns, things like cash and buildings and land and supplies, equipment. Liabilities are debts that a business owes. So accounts payable, which means money that you owe to your creditors, or notes payable, which be money that you owe to banks or others that you've taken loans from. And then equity is the part of the business that belongs to the owners, and that's usually listed as what's called common stock, which is the money put in by the owners, and retained earnings, which is any money the business has earned and not paid out to the owners. So there on the bottom, you can see the expanded accounting equation, which is assets equal liabilities plus equity. And then they have equity expanded out into contributed capital. That's money put in by the owners, common stock, and retained earnings. And retained earnings is the revenues minus the expenses and minus the dividends. And dividends is money that's paid out to the owners or shareholders of a business. Revenue minus expenses is what we call net income. That's which we'll learn a little bit more about here in the future. So what we're going to do now is just look at some transactions and see how they'll impact that basic or fundamental accounting equation. So our first transaction is an investment by the owner. So Chaz Taylor invests $30,000 cash in the new company and receives common stock. So the accounts that are involved are going to be cash and common stock. So our cash is going to go up, and our common stock, which again represents money put in by the owners, that will also go up. How will that impact the accounting equation? We'll see that our assets will go up or increase by 30,000, and our common stock, which is part of our equity, will go up by 30,000. So recognize that with each transaction, this accounting equation has to stay in balance. So assets on one side and liabilities plus equity on the other has to always be in balance. Let's look at another transaction. We purchased supplies paying $2,500 in cash. So the accounts impacted are going to be cash, which is an asset. It's going down because we're paying out cash for the supplies, and supplies, which is an asset, going up. So how will this impact the accounting equation? We'll see cash going down by $2,500. You'll see that that's in parentheses. That's in accounting. We sometimes put things in parentheses instead of using a negative in front of it, but it means the same thing. So a negative 2,500 can be represented by 2,500 in parentheses. So cash goes down, supplies goes up. So assets stays the same at 30,000, and then the liabilities plus equity stays at 30,000. All right, let's look at another transaction. We purchase equipment for cash. So we pay $26,000 for equipment. So again, cash will go down, equipment will go up, and again, that's going to impact our accounting equation with a negative to one asset and a positive to another asset. So the total overall is that asset stays at 30,000, and then our liabilities plus equity didn't change again on that one. All right, next transaction, we purchase supplies on credit. So when we say we purchase something on credit, what that means is we aren't paying cash for it. Instead, our supplier is telling us that we can pay for it later. That's really normal in business. And so the supplier is going to say, pay us within 30 days or something like that. So what's going to happen here is our supplies asset is going to go up, and our accounts payable asset, our accounts payable, which is a liability, is also going to go up. It's easy to get confused by this and think because liabilities are debts, to think, oh no, that's going down. But if you owe more, that's considered an increase in the liability. So our liability increases. So how will that impact our accounting equation? Well, we'll see that our supplies asset increased by 7,100. So our new supplies balance is 9,600. Our accounts payable increased by 7,100. And so our overall assets is now 37,100, and our overall accounts payable, liabilities plus equity also 37,100. Again, they always stay in balance. I think hopefully at this point you're starting to get the idea. There's a bunch of these examples, so I'm going to actually go ahead and kind of go a little more quickly through the next few. If it's still too fast, you can slow it down on the video. All right, so we provide services for cash. And so that means our cash is going to go up, and our revenue, which is part of our equity, is also going to go up. So again, how's that going to impact the accounting equation? Well, our cash goes up. That's an increase to the assets, and our equity in the form of revenue, which is going to impact our retained earnings. Okay, and we'll learn more about this as we go forward. Also goes up by 4,200, so we're still in balance. All right, so now we pay some expenses in cash. So we're going to have our cash asset going down, and we're going to have our rent expense go up. So interestingly, expenses have the impact of reducing equity. So if our expense goes up, our equity is going to go down. We also pay our salaries expense. Same thing, the expense goes up, which makes our equity go down. This is just telling you what I just told you. So how does that impact our accounting equation? Well, our cash goes down by 1,700, the 1,000 and the 700. Our expenses go up by 1,700, which reduces our equity by 1,700. And since our cash went down and our our expenses went down, then our balance is going to be the same, or our overall balance of assets and liabilities plus equity. All right, on our next transaction, we provide consulting services of 1,600 and rents of 300 to a customer for credit. This means that the customer hasn't paid us yet, okay? So what's going to happen is we have an account called Accounts Receivable. That means money owed to us by our customers. That's going to increase. And our consulting revenues, which is going to impact our equity, and our rental revenue, which is also going to impact our equity, also going up. So accounts receivable and asset increases. Revenues, which increase equity, also increase. And so our overall balance will be the same both on the asset side and the liabilities and equity side. All right. Here we pay $1,900 for consulting services. So our cash is going to go down. A client pays us, sorry for that. So our cash is going to go up, and our accounts receivable is going to go down. So these are people who paid us for money they already owed us back from transaction number 8. So if one asset goes up and the other asset goes down, that means there'll be no change to the overall asset balance and no impact on liabilities and equity. So we'll still be completely in balance. All right, we pay $900 as partial payment for the supplies purchased in transaction 4. If you remember, when we bought those supplies, we didn't pay cash. They allowed us to pay for it later. So now we're going to pay $900 that we owe to them. So our cash asset will go down, and our accounts payable, a liability, will also go down. Why? Because we owe less money to them now that we're paying it off. So the way this will impact our accounting equation is our cash will go down by 900. So the assets, overall assets, will go down by 900, and our accounts payable will go down by 900. So our overall liabilities and equity will go down by 900, and we'll still be in balance. All right, we're getting close. So if this feels long, well, just know that it's getting close. So here the owner withdraws $200 cash for personal use. Anytime a business pays money out to an owner, we call that a dividend. So the accounts involved are going to be cash, which is an asset going down, and dividends, which is just like expenses, an increase to dividends will be a decrease to equity. So cash goes down and equity goes down. How will that impact our accounting equation? Well, we'll see a negative 200 to cash, which will decrease our overall assets by 200, and a negative 200 to dividends, which will increase our overall liabilities and equity by 200. And so our totals will still balance. So here's a summary of all of our transactions that we just went through. It was a lot. We went through 11 transactions. You can see how the balances of each account change. And at the very bottom where it says BAL, that's the ending balance. And so we'll see that after all of those transactions, still our assets will equal our liabilities plus our equity. One last concept I just wanted to touch on for this chapter is the 4 basic financial statements that we'll see in the course. And that we're going to spend some time learning in this first chapter, and actually chapter 12, which we're going to cover at the same time. So we have the income statement, which describes the revenues and expenses. And so it summarizes the amount of money that you make from selling stuff minus the expenses. And if you make more money, so if you bring in more money than you pay out, we'll call that a net income. And if your expenses are greater than your revenues, we'll call that a net loss. Second is a statement of retained earnings, which will explain changes in the net in the retained earnings. Remember, net income increases our retained earnings, and net loss would decrease it. And dividends would also decrease our retained earnings because that's paying money out of the business to the owners. The balance sheet will cover the assets, liabilities, and equity. And then the statement of cash flows will help us identify cash flows. So what we mean by that is sometimes we'll have cash come in or cash go out that doesn't match up exactly with the expenses or the revenues. And we saw that already in the example where if I earn money, but then I allow the customer to pay me later, then my revenue will go up, but my cash won't, not until later when they pay me. And so the statement of cash flows helps us reconcile those changes in revenue and expense that don't always match up perfectly with our cash. So here's our income statement at the very top. You can see that there's revenues, that's money that the business has earned, expenses, costs that the business has incurred, and that revenue minus expense is going to be our net income. The second one is our statement of retained earnings. Because it was a brand new business, we can see it had a retained earnings of 0 to start. We add in the net income, subtract out the dividends, and that gives us our retained earnings at the end of the period. And then the bottom one there is our balance sheet. And again, you can see the assets are on one side, and our liabilities and equity are on the other. And then as it shows, our total assets will equal our total liabilities and equity. Also recognize that information flows through these statements. The net income is needed to calculate the amount of retained earnings, and the retained earnings is needed to calculate the total equity, which we need for the balance sheet. So they all sort of work together. Finally, we have a statement of cash flows. And so the cash flows off of the balance sheet onto the statement of cash flows. And there you can see summarized the cash that comes into the business and goes out of the business from operating activities, the cash that comes into the business and goes out of the business for investing activities, and the cash that comes into the business and goes out of the business for financing activities. And at the end, you'll see a summary of what our cash was at the beginning of the period, which was 0 because it was a brand new business, and what it was at the end of the period. So there you go. That is a quick run through of the concepts and items that we're going to learn more about during chapter 1. I hope it's helpful to you, and I hope that you have a great day.